Hey everyone, welcome to the first video of the Audit Quiz Walkthrough series. Now the purpose of these videos is, what we'll do is we'll go through these practice quiz modules which are actually located on our exam prep course for audit. And the aim of these videos is not just to tell you the answer, right? The aim of these videos is to give you a set of tools and a set of framework so that you know the right approach to how to approach these questions. You can then go off and practice as many of these as you can in your own time. And as you can see with each of these quizzes, which we've got one for each module, there's a lot of questions available for you to practice, right? So for example, for module 1, we've got 53 questions. We're not going to go through all of these questions in these videos. We're primarily going to go through a sample from each module. We're then going to show you what the questions you should be asking, what the mindset you should be taking, how do you deduct which one is the correct answer by working out incorrect answers and using logic. How do you use the notes that we provide to answer these questions correctly? And what's the correct answer and why that is the correct answer. So it's not just about telling you the right answer, it's telling you about how do you do it so that you can go and replicate it for the rest of the questions. So that being said, let's get started on question 1. So which of the following statements best describes the term assurance services? A, the assembly of financial statements based on assumptions of a responsible party. B, services designed for the improvement of operations, resulting in better outcomes. C, services designed to express an opinion on historical financial statements based on the results of an audit. And D, independent professional services that improve the credibility of information or its context on decision makers. Now, this is one of those questions which is probably, you could do it a couple of ways. Number one, you could either look up in your notes specifically assurance services, and that'll take you exactly to the definition of what it is. However, I also want to make sure that you kind of understand, rather than just looking at the answer in the notes and just, that's the answer because it's that. Although that's a perfectly fine way of doing it, you're going to get the correct answer. But in those tricky questions, if they ever throw a curveball, it's better to also understand the concept and the definitions and, why it's the correct answer as well, because that's going to put you in a better place if there is a tricky question, right? And it also allows you to move quickly on questions that you know for sure. So, for example, assurance services is one of the concepts that we discussed in our core content videos. So it's a good way, once you get that foundational knowledge, you can probably figure out the answer pretty quickly, right? So as a quick recap, assurance services is not just an audit, but it's also kind of review work. And it's any kind of work where you're saying you've got a particular set of information that you're checking, whether it's financial statements, usually that's the case, but it doesn't necessarily just have to be financial statements. It could be like a P&L, or it could be just, non-financial information. It could be a review of compliance with a certain, law. It could be just, a review of certain information to make sure it's correct. And it's also saying to a third party, this information has a certain level of, there's no fraud that we've identified in here. There's no issues that we've identified in here that are material. Depending on what the level of assurance that you're providing is, how much confident that you are that the information that we're looking at is correct, perfect, free from error, and free from fraud, etc. So let's try and do it by logic first, and then we can just look at the notes and figure out what the correct answer is pretty quickly. So A is the assembly of financial statements based on assumptions of a responsible party. So, clearly an audit or a review does not involve the assembly, like the preparation. So the preparation is done by the entity itself preparing financial statements. For example, if we're auditing or reviewing Apple is going to be the one preparing the financial statements. They then give the completed financial statements in draft to the auditor or the reviewer providing the assurance services. They'll then check it and give it back, right? And then make a statement regarding that. So clearly this is not the right answer. Then B, services designed for the improvement of operations resulting in better outcomes. Again, an audit or review under assurance services is not about improvement of operations. Maybe if you went and got a management consulting company to come and give you a report, then yes, definitely that may be applicable here. But an audit is primarily to check the correctness or accuracy, credibility of a specific piece of information. Right? So that's clearly not the right answer either. So C, services designed to express an opinion on historical financial statements based on the results of an audit. I would understand why you might think this is the correct answer, because this would be correct if this said audit, right? But as we know from our core content, and we can also quickly check this in our notes by looking up assurance services, or if you just go to the first module, we know assurance services, just bring it over here. We know that assurance services involve both. So we know from the notes that there's two types of assurance. There's audit, or there's reasonable, which is, for example, audit of financial statements. So it's providing a higher level of assurance that the information is correct. And you've got limited, which is review of financial statements, right? So a review. That's providing obviously less assurance that everything in there is correct. So so C is specifically focusing on audit, so therefore it's incorrect because assurance includes the definition of both review and also audit, right? So limited and reasonable assurance. So therefore the fourth one is independent professional services that improve the credibility of information or its context for decision makers. So, I mean, that makes the most sense because if you think about the purpose of an assurance engagement, it's primarily to, ensure that the information, or assure that the information in there is reliable when making decisions, right? And that fits in with a definition specifically in our textbook, which is assurance services are independent professional services that aim to improve the quality, relevance, and reliability of information necessary for decision making. And that also happens to be the specific word of question D, which is about improving the credibility of information for decision makers. So clearly D is the correct answer. Cool. All right, next question. What type of threat to the professional independence identified in the International Code of Ethics for Professional Accountants is created when the auditor gives a discount on wine purchases by a client that operates a winery? So for this one, we need to know what the threats to independence are. So we can do a Control F in our notes. But you might already know this from going through the ethics and governance subject, but it's also mentioned in various other subjects, like it's mentioned in the tax subject, it's mentioned in financial reporting as well. So you probably already know a little bit about this already, but let's just, for recap, we'll bring up the threats. So we're going to do a Control F for threats in the notes. That should bring us up to, here we go, over here, got there pretty quick. I just did a Control F for threats, scroll down a little bit. Oops, do it again. Just scroll down and you should get to the threats. Fundamental ethical principles jeopardized by threats. So you got self-interest, which is, when you might have a bonus or a bribe or something which, makes you be less objective as a result of it. Self-review, when you're reviewing your own work or, based on work very close to you. So, you're not going to pick up all the mistakes you would with a fresh pair of eyes or that, unbiased that comes with not reviewing your own work. Advocacies, when you're representing your client in a particular way. For example, you've got your accounting firm with two different clients and you're saying to one client, go to this client because they're going to give me a bonus or something like that. So your objectivity is not being compromised. Familiarity is when you've been with them too long, and you might be too sympathetic to their interests or accepting of their work. And then finally, intimidation is when they're deterring you because of actual or perceived threats. For example, if you don't give us a good opinion in the audit, we're not going to go with you next year as an audit client. That would be intimidation. So which one of these threats is created when the auditor is given a discount on wine? So clearly there's some sort of dollar benefit there, right? It's not as great as saying, I'll give you a 200k bribe if you give us a good audit opinion. But, at the same time, there is some dollar benefit there, right? So an auditor can't really accept these kinds of gifts in case the objectivity is impaired by those gifts, right? So it's not a financial threat. The reason is it's not a financial threat is because that's not one of the options on here. That's just a red herring there. B, self-review threat. So remember, that's when you're kind of reviewing your own work. Clearly, there's no element mentioned here where they're reviewing their own work, so that's not the correct answer. Self-interest we mentioned was when, your objectivity might be under threat because, you're giving some sort of financial or other interest as a result of your role. And then finally, intimidation threat, which is, threatening you. So clearly there's a financial benefit here, right? So that would be self-interest. It's not far off intimidation, right? But intimidation is more about, we're going to take away this, or it could be physical violence, or it could be we're not going to engage with you next year as a client, right? But that's not happening here. It's just a gift. So clearly it's self-interest threat for that one. All right, for C, for a financial audit of a government department carried out by an Auditor General Office, which of the following would not be an output of the audit? So we're looking for one that would be incorrect. Okay, so just a quick recap of what the Auditor General actually does. So they basically, in a sense, audit government spending, right? Okay, so keep in mind that the question is asking us about a financial audit, right? Because there are different kinds of audit. A financial audit is specifically looking at financial information, right? So there's going to be certain processes which are specific to a financial audit, right? Whereas alternatively, you could have a performance audit, for example, which is focusing on, the efficiency of spending, which is particularly relevant for Auditor General. So anyway, how I would approach this question is I would do a Control F in the notes for Auditor General. It's fairly specific. That is going to take you to the section in Module 1 notes about the public sector perspective, right? So this just talks about how the control of public expenditure is one of the main responsibilities of government, because what they do is they collect money from taxpayers and they spend that money, right? So we need to first of all make sure that there's no fraud and anything they report is accurate, reliable, and all the usual, audit stuff. Like if they're going to audit a particular department, whether that's, justice or Premier, etc., making sure that there's no fraud happening, making sure they've got controls to prevent fraud and things like that. And then at another level, they're going to have performance audits, right, which is to make sure that government as a whole is spending money effectively. So that's covered down here in the notes. So basically, so the Auditor General works for the ANAO, which is the Australian National Audit Office, and the ANAO's primary client is Australian Parliament, so that's who they report to. So the ANAO's purpose is to do two things. Number one, financial statement audits of Australian government entities. That's the normal audit process where you're still going to do all your controls and your substantive analytical procedures. You're going to come up with an audit procedure. So it's almost exactly the same as if you're auditing a company, but just replace it with a particular government entity. And then separately, as I mentioned before, we've also got our performance audits, which talks about, how effectively and efficiently is the government spending its money. So this is actually covered in detail in a later module. But this is probably something that companies don't necessarily always do, but companies always do this one. This one's probably unique to the public sector specifically. So having said that, let's have a look at the possible options in our multiple choice. So the first one is, and remember we're looking for one which would not be an output of the audit. Remember the audit is the financial audit, not the performance audit. So the first one is an audit opinion on the financial statements. So, in any given audit, financial audit, there would be an audit opinion, right? That's just an element of the audit process that we know from the core content videos. B, a report to Parliament on significant issues arising out of the audit. Again, just replace the words Parliament with company and just see if it's true for a company, and that's probably true for the financial audit part of it. So if you're auditing a company, you would also need to provide, a list of key issues arising out of the audit. So this one would also be true for the financial audit of a government department. Part C, an opinion on whether taxpayers' money is spent efficiently, effectively, and economically. So this one is basically testing you on your knowledge to be able to distinguish between a financial audit and a performance audit as part of the Auditor General's role. So clearly, an opinion on whether taxpayers' money is spent efficiently, effectively, and economically is to do with part 2, a performance audit, right? Efficiently, effectiveness of spending. So that would not be part of the financial audit, right? So that's probably going to be the incorrect answer, but let's just double check D just in case. So a letter to the governing body of the auditee that includes observations about the quality of internal controls. So similarly to the letter of key issues as part of an audit of a company, you'd also talk about controls, right? So clearly this one will also be okay for a government department financial audit. So that means the odd one out is C, an opinion on whether the effectiveness and efficiency of government spending. All right, next question. So the IFAE indicates that in practice, a professional accountant should be able to provide which of the following levels of assurance on various engagements? A, absolute, B, high or low, C, appropriate, or D, reasonable or limited. Okay, so this is going to draw on our general knowledge that we've learned from the core content videos. So in any audit, we've mentioned this a couple of times, it's impossible to have absolute assurance. It's just not possible in audit. So the purpose of an audit or a review is not to provide, is not to tell the users that there is no errors or fraud in any piece of information you're auditing. You basically word it in a way that depending on the level of assurance that you're providing, which is never absolute, that you either have, based on the information that we've reviewed, we believe that there is no, or we haven't identified any fraud, and we don't believe that there to be any fraud or a material error. That's providing a high level of assurance, because you're not saying there is none, you're saying we believe, based on what we've looked at, that there probably isn't, or there's a low probability. right? Or if you have an even lower level of assurance, you're saying, based on the work that we have looked at, we haven't identified any issues within this particular piece of work, and you don't comment on the rest of the business. So in either case, you're going to provide a high level assurance or a low level assurance, but never an absolute level of assurance, right? But the technical words that we're using for this level of assurance, because they have very specific meanings, is not high or low, even though that's the way I'm describing what they mean, because they, specific definitions have specific meanings. If you go back to our notes, what we talk about is that you either have reasonable assurance or limited assurance, right? That's on the very first page, one of the core concepts that we've been talking about throughout the entire module. So a reasonable level of assurance would be an audit, and that's basically a level of assurance that a reasonable person could say, we're going to look at this and say, we've looked at a reasonable amount of the financial statements. We don't believe there's any material error. We've done a reasonable amount of work. Therefore, a reasonable person can rely on it. Whereas limited means you've only done it up to a certain point, whether that's looking at one specific piece of information or you've only put in a certain amount of hours or work on looking at it. Therefore, the risk of not picking up error or fraud is much higher, right? So clearly the answer is either reasonable or limited. Right? So that one is correct. So B, I understand why you would choose B, high or low, because in a sense what you're doing is either providing a high level assurance or a low level assurance, but we're looking for the technical terms used in the audit module. And of course, we're looking for the most correct answer in any multiple choice question, not just the correct answer, because sometimes there can be more than one correct answer, but it's always the most correct answer. Okay, so this question is, according to ISA 200 overall objectives of the independent auditor and the conduct of an audit in accordance with the international standards of auditing, reasonable assurance is obtained when the auditor has reduced audit risk to A, a reasonable level, B, an acceptable level, C, a reasonably low level, or D, an acceptably low level. So there's a few ways you can approach this question. Number one is using your knowledge from the core content videos. If you're not quite sure, if you just want to double check, because the answers are quite similar in terms of wording, what you can do is, one trick is to actually do a Control F in the notes based on the words in the answers, because some of these have quite specific wording. For example, you could search reasonably low level, or you could search acceptably low level, see which one comes up. That's most likely going to be the answer for you. Another way is you can actually go to the section where we talk about reasonable assurance engagements, which is not far off the first page. It talks about the level of assurance. Obviously, there's reasonable and limited, which provide high and low levels of assurance. And when we talk about reasonable assurance, which is what the question is asking us about, reasonable assurance, we then want to know what the risk level is that an auditor needs in order to pass the audit effectively. So reasonable assurance is a high level assurance, but not an absolute level of assurance. Okay. So reasonable assurance arises when the auditor obtains sufficient appropriate auditive evidence to reduce audit risk to an acceptably low level, right? So clearly the answer is an acceptably low level per ISA 200. The other way you can do it is you can just, if we just scroll to the top and we just do a Control F for some of the different words. For example, if we try reasonably low and then we try acceptably low, right? So we'll just do a Control F, go acceptably low. There we go. There's the answer here. Reduces audit risk to an acceptably low level. So clearly that's the answer, and that's how you approach that question. Pretty straightforward. Next is, which of the following statements is correct? A, audit risk is the risk of material misstatement in the financial statements. B, the risk of material misstatement in the financial statements consists of control risk. C, audit risk is the risk that the auditor will not detect a material misstatement that exists in the financial statements. D, audit risk is the risk of material misstatement in the financial statements that the auditor will not detect the material misstatement. Alright, so what we can do here is we can do a Control F for audit risk. That's going to take us to the relevant statements. That's going to take us to the subtopic on audit risk. So just as a quick recap as to what it actually is. So it's the risk that the auditor will express an incorrect opinion, i.e. they say there's fraud when there's not, or they more likely is there is fraud in the financial statements, but they've said that there isn't fraud or material misstatement, right? So let's say the auditor checks 10% of the business, doesn't find any issues. They haven't checked the other 90% of the business, and there's very big issues. So in that 90%, there's a lot of errors and fraud, but they've said based on the 10% that there isn't. That's an audit risk, right? And what auditors need to try to avoid. But it's made up a combination of inherent risk, which is basically the fact that some complex calculations, some accounting estimates, some of those complex elements are, there's inherently going to be some risk in terms of A, you might not understand it, B, you might not have the appropriate skill set to do it, or the appropriate resources, or it's a new change, and so you just might not be able to pick it up based on that inherent risk. Control risk is the risk that if an auditor is relying on the controls of the entity, but remember you can do test to controls, and let's say a particular transaction is done 100 times, so you check the review process is working, internal review process, and if that internal review process is working, you can say, well, there's a good chance that it would already pick up an error in those transactions, therefore we can rely on that, we don't need to do the work there, we can focus on the higher risk areas. But the risk is you rely on a control and the control actually doesn't work, maybe they've been faking the review, they didn't actually check it, therefore there's material misstatements in that area, there's a risk of fraud or misstatement because of this control failing that they've relied on. And then finally, detection risk is basically just whether or not the auditor can pick it up based on the work done, either the adequacy or effectiveness of the audit procedures, maybe they've used junior staff, they haven't had experience, maybe they didn't do a good job, maybe they didn't have enough hours to put in because of cost constraints and things like that, right? So you combine all those, that gets you to your audit risk, which is, remember, ultimately saying that the financial statements do not have fraud or misstatement. When they do, they just haven't detected it, right? That's audit risk. So based on that recap of information, which one do you think is the correct answer? So audit risk is the risk of material misstatement in the financial statements. That's not telling the whole story, right? Because it's not just the risk that there's misstatement, it's the risk that you've said doesn't have misstatement when it does, or vice versa, but it's more likely to be the first option I said. So it's probably not going to be that one because it's not really reflective of what the true point is. B, the risk of a material misstatement in the financial statements consists of control risk. I mean, it's not really the answer. What we should be saying is audit risk is comprised of control risk, detection risk, and inherent risk, right? That's not really telling the whole story here. C, audit risk is the risk that the auditor will not detect a material misstatement that exists in the financial statements. I mean, look, it's getting better than A and B because it's saying, part of the risk is that they won't detect it, but they need to fill out the sentence by saying that there isn't an issue when they haven't detected an error that does exist, right? So that's only telling half the story. And then finally, D, audit risk is the risk of material misstatement in the financial statements and that the auditor will not detect the material misstatement. So that's probably the best answer so far. So it's saying that they're not detecting a material misstatement where there is a material misstatement in there, right? So clearly that's the correct answer. Cool. All right, next question. Your client has a December year end with December and January being very busy months. The client has decided to make a public offering next year. In the audit of sales revenue, the auditor would be most concerned with which of the following assertions? A, cutoff, B, accuracy, C, classification, D, completeness. So we can do a Control F for either assertions, or we can do a Control F based off either of these words. Should take you to the same place, which is basically the section in our notes based on assertions. If you need a little bit extra help, remember we also have our in the folder in the CPA notes, we've also got procedures and assertions. This is a bit more detail than you probably need, but it gives you examples, for example, of each of the different assertions. What's an example test that you might need or audit procedure to do on that particular one for each of the different categories, right? So inventory, prepayments, etc. But, it's probably more information than we need right now. All we need is very high level. So let's focus on what are the assertions. So the first thing to know is depends on whether you're doing a balance, like in the balance sheet, or a disclosure, or if it's a transaction. So transaction, for example, is more likely to be on the P&L side. So revenue would be a transaction, not a balance sheet. Whereas a liability, like a provision, would be on the balance sheet because it's a liability, right? So because the question specifically is asking us about revenue, which would be a transaction account, we know that the options that we need to rely on are these ones here. So occurrence, completeness, accuracy, cutoff, classification, and presentation. So if we have a look at our diagram over here, so in the notes, so first one, let's just do a quick recap of what they actually mean. So occurrence is, has the transaction actually happened, right? So just because it's on the GL doesn't mean that there's an invoice attached to it, doesn't mean the cash is actually being paid for it. It could have just mean the accountant just put through this journal, right? That could have been fraudulent in order to achieve a sales bonus, right? Something like that. Completeness, is it all recorded? So checking the bank account. The cash has come in, the invoice has been generated, but the accountant forgot to post the journal entry for it. So they've actually got more money that's sitting in there, the bank account, that's not being accounted for on the GL or the TB or the P&L, or whatever it is you want to look at. Accuracy, is it calculated correctly, right? So that, for example, sales revenue, they might have accidentally put the decimal point too early, and now instead of being 100,000, it's now $10,000, right? So not accurate, it's there, and it happened, but it's not the correct dollar value. Next is cutoff. So is it in the correct accounting period? So, a transaction which should have actually been incurred in January because the cash came in on January 1st is included in the December P&L, but we need to think about, what is the accounting definition per IFRS of when it should be recorded. It should be in that month. So this is more making sure that the timing of the transaction is correct. This one is classification, so making sure it's in the correct account. So for example, putting a revenue transaction in cost of goods sold, for example, by accident, it's incorrect. And then finally, presentation, is it corrected presently? Have you followed all the requirements of IFRS? Are there any relevant disclosures that you need that should have been reported at the back of the financial statements, and so forth? So with that quick recap, understanding which one the correct assertion is, really we need to understand what the client's situation is. So for example, they've got a very busy December, right? And January is a busy month, right? So I guess the first thing is, could they have missed something in that period because they're busy? The next thing is they're making a public offering next year. So logically, if they're going to make a public offering, they want to have the highest possible revenue. They want to have the highest possible profit, because when they present to investors using this year end, or the last year end, because it takes some time to get that ready, get the pitch book ready, the investors are going to want to see big numbers, right, and high growth, right? So there's going to be pressure in this company to inflate that December year end. If it's in January, it's not going to really help them, even if it's a really good month. So there might be some incentive for them to kind of push some of January numbers into December, right? That's the second thing to consider. So the order would be concerned with which of the following transaction assertions for revenue: cutoff, accuracy, classification, completeness. So let's go by these one by one. So the first one is cutoff, and that's to do with, could any of the sales in January actually be allocated December, or vice versa? Are there any sales in December that actually should belong in January? I mean, this one makes sense given the situation, because if they're trying to IPO, they're trying to maximize their December year end, there might be incentive to push some of the January sales into December. Therefore, there might be a cutoff issue, right? So we need to review that. B, so this is most likely the correct answer, but let's just check the others just in case. Accuracy. So that's when they've, moved the decimal place, for example, and instead of reporting one transaction as $10,000, they've done it as $100,000. Well, there's nothing in the background information that suggests that might be a particular risk. I mean, it's possible, but it's not necessarily the most correct answer based on the question. Classification, again, sales versus COGS, putting it in the wrong category, unlikely to happen. And there's nothing in the question to indicate that that might have happened. Again, it could happen, but it's not the most likely or correct answer, which so far is still cut off. And then finally, completeness. So basically, is it all recorded? Is there a risk that they go to their bank account and there's money there that they haven't reported in the GL? Again, it seems less likely, because the CEO and the CFO, wanting to maximize their December revenue, are going to be checking everything possible because it's in their interest to maximize December. So it seems unlikely that they've got extra revenue or cash received in the bank account that hasn't been allocated to revenue. The risk, if anything, is that they're inflating it, right? And the only one which corresponds with that is cutoff, right? So that's why it's really important, especially in the audit planning section of an audit, that you think about the client. What's their situation? What's their incentives? What are they likely to do? Where are the risk areas? And that's most likely the areas that an error or fraud is going to occur, and you should be focusing extra resources on. All right, next question. In the audit of trade payables, the auditor is normally most concerned with A, existence, B, completeness, C, rights and obligations, or D, accuracy, valuation, and allocation. Okay, so this is starting to get into the tricky assertion questions. So this one is now about a balance sheet question, because it's trade payables, which is a liability, which is a balance, not a transaction. So what I'm going to do is I'm going to bring up the notes again just a little bit further down, which is about assertions on account balances. So the key assertions are existence, i.e. does it exist or is it fictitious? And you do that when you want to overstate something, for example, inventory, right? Because if you want to have more inventory, it's going to look too good to investors, but the auditor needs to check that the inventory actually exists in real life or isn't written off, right? They're less likely to do that with liabilities, though, because you don't want to overstate your liabilities. Next is rights and obligations. Do we have the authority over it or legal duty relating to it? So, for example, inventory, another good example, because a lot of inventory is sold on consignment, which means the person, like the manufacturer, might still own the inventory until it's sold. And if they can't sell the inventory, then the manufacturer owns it. So the auditor might see the inventory there, but does this company actually have the right over it? Because they might put $1 million of inventory on the balance sheet, but then in reality, the manufacturer says, well, you didn't sell it, I'm going to take it back, $1 million gone, right? That one's important, particularly for assets. Not so important for liabilities because, well, generally if you're going to record a liability, you have to pay it. That's your obligation, right? Generally, you want to kind of minimize this. Next is completeness. So is it all recorded? So for example, go to the warehouse and count the number of trucks that they have there. They've got 7 trucks on the balance sheet. They've got 6 trucks. That means they must have missed one, either an error or a mistake. Seems unlikely that they'd intentionally understate their asset values. Probably more relevant for liabilities because they want to check, because a company is more likely to want to understate its liabilities. So you need to check all of the obligations of this company. Maybe looking through, agreements that they've, looking at earn-out liabilities, for example. Make sure the company's recorded all of them and not try to look better by saying we don't have as many liabilities as we actually do. Next is accuracy, value, and allocation. And this is just saying, have they allocated, you measured it correctly, did they make a mistake and miss a decimal point, which is understated by $1,000 or $10,000? And also, you'll notice that this is similar to accuracy up here in transactions, but it's also got valuation and allocation. So this kind of combines, how it's allocated, how it's valued as well. For example, with balances, you might have a fair value or cost value, for example. So is it valued it the right way? And then you've got classification. So is it in the proper accounts? Similar to this one, making sure that your, for example, a common one with balance sheet items is short-term versus long-term liability. Has it been allocated in the correct classification there? And then finally, presentation. Is it correctly presented with disclosures as required by IFRS? So let's go back to our question over here. We need to consider what the client situation is. So clearly it's a liability. So inherently a company would try and minimize the liabilities on the balance sheet and maximize their assets because that's going to make them look the best. So we want to look at which of these risks is a risk for understating a liability. So existence, does it exist or is it fictitious? So remember, this might be a risk for a company with assets. If this was an asset account like trucks, let's say they've got 10 trucks. The auditor is thinking they want to maximize the number of assets on the balance sheet, so I need to check that these actually exist. They say they've got 10 trucks. We go there, we can only find 5 trucks and say, well, where are the rest of them? So, oh, we made a mistake. It's overstated by 5 trucks. You've got to write that off, right? So that's a risk for an asset. For a liability, less so, because it's unlikely that you would have extra liabilities on your balance sheet that when they check if it actually exists, realize that they've overstated their liabilities, maybe by mistake, but not intentionally. So this one is probably not the key issue. Remember, all of these could potentially be issues, but we're looking for the most likely situation based on this. Next is completeness, right? So we want to know, is it all recorded? And for a liability, this is a risk, because remember, completeness is about, is it all recorded down? So they've recorded, $10,000 of liability, but then once, as auditors, we go and check all the obligations in the sale agreements or other contractual agreements. We realize that they've actually got an obligation for $100,000, and the company, because they don't want to put in the effort to make sure they got it all right, more likely they've missed it or deliberately understated it. So most likely completeness is the correct answer. Next is rights and obligations. So this is just making sure that we actually own the liability. Again, more relevant for assets because companies will want to overstate it. So for example, for inventory, they may be incentivized to say that inventory is ours and on our balance sheet, but really it's on consignment and we don't own it. So that's incorrect. And then finally, D, accuracy, value, and allocation. I mean, it could be a risk that they've valued this wrong, or put it in the wrong account, but realistically, it's not high probability based on the situation. The only high probability based on the situation is completeness, because the company may want to understate the number of liabilities on its balance sheet. All right, next question. Your client is in a highly competitive industry with a majority of competition coming from overseas. Its products have a relatively short life cycle, and a product development is continuous in order to keep up with its competitors. For the inventory count, the assertion upon which most audit effort should be concentrated is A. Existence, B. Completeness, C. Rights and obligations, or D. Accuracy, valuation, and allocation. So let's talk about what each of these actually mean, and I can flash the notes again, but it's basically what we went through in the last question. So existence, rights and obligations, completeness, accuracy, valuation, classification, presentation. There are the meanings there in its shortest possible form. So let's go through each of these and what the potential implication is for inventory. So the first one is existence. Does the inventory actually exist? Potentially this could be relevant, but the keyword here is highly competitive industry. So probably the keywords is, potentially if competitors are coming in with the same stock, it might mean either they're being innovative on their products, so maybe they're making our products obsolete because of that new innovation, or maybe they're cutting down on price, which means that maybe the way that we're valuing our inventory isn't as valuable as we thought it was, right? That's probably the most correct based on the background information that they've given us. And also the fact that they've got a relatively short life cycle, so the risk of obsolescence is high because of this. And product development, so a continued innovation is continuous. So again, another factor suggesting obsolescence. So all of these in the background information is saying obsolescence is the key risk for this company. Which of these assertions is most related to that? So that's not to say some of these aren't relevant for inventory, but we need to figure out, based on the specific question background, which of these relate to obsolescence, basically. So existence might be relevant if they hadn't given us all of that information, because naturally a company would want to overstate their inventory. They want to say, yes, we've got all these assets on our balance sheet, so the auditor naturally needs to check that that inventory actually exists. So this is a hard one, because normally that would be correct, but it might not, and most likely isn't the most correct based on the specific background information, right? So that's a tricky one. So this one's probably not the right answer, even though it is correct. It's hard. Next is completeness. So completeness is it all recorded? And again, it's unlikely that the company would want to do that, because what this means is they've got extra inventory sitting on the balance sheet, which they haven't put in the GL. So there's no incentive for them to do that, right? They've got anti-incentive against that. So most likely not going to be the case. Rights and obligations, again, it could be relevant for inventory because of what I mentioned before about how some inventory could be on a consignment and they may want to claim it in order to boost their inventory status, but it doesn't really fit in with the context, the specific context that they've given us. So this is correct for the question, this is correct for the question, but not the most correct based on the background. And then finally, accuracy, valuation, allocation. This one is the most relevant for, have we correctly valued our inventory, or should we be writing it off to the nearest? If you remember from financial reporting, the correct valuation of inventory is the lower of cost and net realizable value. So that means, yes, even if you paid $1 million for inventory, if you can only get $500K for it, we need to write out the lower value of that. That's the net realizable value. So the correct valuation for inventory in that case would be $500K. So that's particularly relevant for where stock is becoming obsolete, because you might pay $1 million for it, but because if there's more competition coming in, or it's becoming obsolete because of the short life cycle, or damaged, or whatever it is, the value is coming down and down and down, and that means your net realizable value is lower. So this is the key risk here based on the context of the information. But if they've given us a different context, if they're more focused around, something else or if they hadn't given us any background information, one of these could have been correct. But given the circumstances, this is the correct answer here. All right, next question. Your client is a manufacturer of outdoor furniture. The theft of inventory has been an ongoing problem. The key audit risk to be addressed at year-end in relation to inventory is A, existence, B, completeness, C, rights and obligations, C, accuracy, valuation, and allocation. Okay, so this is another tricky question to do with assertions, where we really need to understand what is going on in the specific context of the question, because all of them could potentially be true, but we're trying to find the most relevant to the context. So we need to really dig down and really understand what's going on in that context. So in the question, it's saying they manufacture furniture and theft is an ongoing problem. So what is theft? Theft is basically when you've got goods there which are now no longer there, right? You think it's there, and if you were to read the balance sheet, you would say we've got $1 million in inventory. But if someone's stolen all $1 million of it, and then you go and check and it's not there because someone's stolen it, then you've got an issue where it doesn't exist. but it exists on the balance sheet, but it doesn't exist in real life. Now this is a tricky one because you could also argue that if it's not there, therefore the accuracy and valuation of that amount is at risk as well, right? I would say that's almost equally correct. But if we were to choose between not existing and the value being impacted, I would say not existing is probably the slightly more relevant one because theft, disappear, right? As opposed to valuation, probably more to do with, the valuation one is probably more to do with where there's some obsolescence happening. So it's assuming you've checked it all and it's all there, but the value of what is there is slightly lower because maybe there's cheaper products on the market, maybe your products aren't as relevant and you can't sell it for as much. So I'd say it's probably a slightly different scenario here, and therefore completeness is probably the more relevant one. And the reason I'm saying, existence I should say, not completeness, they're kind of opposites of each other. So existence is where it exists on the balance sheet, but it doesn't exist in real life, right? Does it exist or is it fictitious? So it exists on the balance sheet, but does it exist in real life? That's the question. So that's probably the most relevant one here. Completeness, people get confused between these two or use them interchangeably sometimes, but they're kind of opposites in the sense that this is when it exists on the balance sheet, but we don't know if it exists in real life. And this is where it exists in real life, but we don't know how it's treated or if it exists on the balance sheet, right? So it's the inverse. So this would be more if we've checked it and we know that there's 10 trucks, but then we look in the balance sheet, there's only 9 trucks. That would be a completeness issue. Rights and obligations, not really relevant here. It's just not really relevant. And then so existence, we're saying, does it exist or is it fictitious? This one's the most relevant one because let's say we've got 100 units of outdoor furniture on our balance sheet. Then we go to the warehouse and we check it. There's no units there because it's been stolen, right? Theft is an ongoing problem. Therefore, existence is the key issue, right? Because we don't know if it exists in real life or not. Okay, next question. Which of the following evidence gathering procedures is likely to be most effective in testing the completeness of trade debtors? A, selecting a sample of subsequent cash receipts and verifying that the related sales were cut off properly. B, selecting a sample of customers and verifying that the year-end balance does not exceed the customer's credit limit. C, recalculating the client's aging of trade debtors and tracing a sample of the outstanding invoices to the aging report. Or D, selecting a sample of shipping documents around the year-end and ensuring that all shipments prior to year-end were invoiced and recorded in trade debtors subledger. Okay, so let's go through each of these and explain why it shouldn't be the most effective test for completeness of trade debtors. So the first one here is clearly saying that they want to check sales cutoff. So sales cutoff is not a account balance assertion, it is a transaction assertion. It's to do with, it's a different account for beginners, but it's for assertions, right? And it's for cutoff. Clearly not what we're looking for, which is completeness of trade debtors. All right, next one is selecting a sample of customers and verifying that the year-end balance, right? So trade debtors is basically money that we're expecting to receive from customers, right? So we're going to check those customer accounts and check their balance, like how much they owe, does not exceed their customer's credit limit. And this is important because if you're checking how much they owe and checking the dollar value of that and exceeding, they don't exceed their credit limit, that's basically determine whether we can collect that money from them or not, right? Because part of testing something for, valuation is making sure that it's actually recoverable, right? Because if we need to write off a component, same like how we talked about inventory before, where, inventory, if we thought that the value of inventory was lower than the cost, then we need to write it off down to net realizable value, right? And that's to do with allocation, accuracy, valuation, and allocation. So this is very much the same about because the purpose of credit limits on a customer's account, credit limit is the amount that we are going to set. That's the most they can borrow. Because anything above that, we determined that they probably won't repay it. So if we've got customers owing more than the credit limit, that's probably an amount that we need to write off. So it's not really to do with completeness, it's more to do with accuracy, valuation, and allocation assertion. So A and B so far are not correct. All right, next. C, recalculating the client's aging of debtors and tracing a sample of the outstanding invoices to the aging. So again, this is to do with the aging of trade debtors. So very similar to this one up here. So if we're going to look at an invoice that is 90 days old or more, let's say it's 180 days old, do you think we're going to get that money back? Realistically, no. An aged debtor between 30 and 90 days is probably recoverable, but anything over 90 days, just as a rule of thumb, probably not going to be recoverable. So again, this is something that they want to check against the year-end balance. So therefore, this is another one that's doing accuracy, valuation, allocation. So you might check their invoice and say $100. That ties into our trade debtors amount of $100 for this particular client, but that's over 90 days old, so we're probably not going to get back. So therefore, we probably want to reduce the value of our trade debtors. Again, it's around valuation, not completeness. So A, B, and C are all incorrect so far. Hopefully D is correct, should be by deduction. So selecting a sample of shipping documents around the year end, ensuring that all shipments prior to the year end were invoiced and recorded in the trade debtors subledger. So remember what completeness check is in our notes. It's is it all recorded? So it means going to the source data, looking at what we think it should be from that perspective, then checking the GL, is it all there, right? Because it might be understated, for example. So if we want to check completeness of trade debtors, wouldn't that make sense to then go check the invoices that are outstanding, look at all of them, and then check if they are also recorded in the subledger? Because if it's in subledger, then it's in the GL. That's what this one is saying here. It's checking the source documents, seeing what's there, and then ensuring all of them are recorded in the trade debtors subledger. That would be a test of completeness. So that's the correct answer there. All right. Which of the following is not a general computer control? A, the use of system software logs to monitor attempts to access the operating system. B, the procedure for documenting, reviewing, testing, and approving systems or programs and changes. C, the organizational structure and operation of the IT activity, including controls over access to the equipment and data files. Or D, procedure to assure only authorized personnel receive the output from the weekly update of the trade debtors master file. Okay, so for this question, what I would do is I go to the section which talks about different types of controls. A quick way of getting there would be to do a control F based on general computer control or general IT control. So if you do that, let's do that now. It's going to take us to this section right here, which I'll show you, which is the types of controls over here. So there's many different types of controls, and what a quick recap of a control is, I mentioned earlier that instead, because an auditor has limited resources, it obviously can't check every one of the transactions in a billion-dollar organization because there's going to be billions and billions of transactions. So what they do is they look for high-risk areas, and where there are controls in place, they try and rely on those controls, internal controls. They obviously do some testing of those controls to make sure it is reliable, but if those controls do test, they can do less substantive testing. And what I mean by that is less substantive, less analytical controls. So they can do less detailed tests afterwards. So for example, we want to test the revenue, we want to test the cost of goods sold process, right? So we don't know if that number is correct or not. We haven't identified it as a high risk. So in terms of what we're going to do is we're going to check the controls working. And the control for posting COGS is the suppliers will give us a list of invoices, and of course we check our bank balance for payments going out. So what the accounting manager does is he checks the invoices against the general ledger, he signs off on it, and that's the control, right? Now we know if that process is working effectively, theoretically he should pick up for at least one of the it should reduce the number of errors because he's doing that check. We've looked at the check, looks relatively good. We've reperformed the check a couple of times, seems to be working fine. We haven't identified any errors. Therefore, we're saying the control works. That means we can do less work on cost of goods sold and use our limited time to focus on more important stuff, whether that's revenue, whether that's completeness of inventory, obsolescence. We can focus on those key risk areas instead and do a better job with our limited resources. Anyway, that's a bit of a quick recap of controls, and there's obviously many different types of controls. That was just one very basic example. That was like a processing control. But there's also things like computer control. So for example, if you're in payroll and we know that casual workers cannot get sick leave. So a simple, control, whether that's in a particular application or across all IT software in your organization, is that, so an application control, for example, is specific to one application in particular, the payroll system, for example. We might prevent, if you're typing in a payroll report, if the worker is casual, you cannot lodge the report, if it also has casual leave. So that's one good control to prevent an error in the valuation of payroll expense, right? Or the accuracy of payroll expense, I should say. Or you could have a general IT or general computer controls, which prevents all of your organization's control. So in your application. So for example, maybe it's having an audit trail across all IT payroll software, so that if you make a change and the auditor wants to know who made the change, they can track that in the IT ledger. Right? So that would be a good control, because then if anyone's going to process fraudulent transactions, it's going to be a disincentive for them to do that, right? Or maybe it's all, dollar values over 25,000 needs to be approved by, the CFO or something like that. And that way it also prevents material fraud from occurring, because then the CFO needs to sign off on it, and it's not something that, someone in payroll or someone in accounts payable can just process themselves and do a fraudulent transaction to themselves. So that's just a couple of examples. You've also got input controls, which means, so for example, when you go on a shopping website and you type in numbers on a form, your credit card details, you obviously can't put a date or text into a credit card form because you've got an error, and it also recognizes exactly what kind of card it is based on the number order. So it can tell you it's either Visa or MasterCard, and it will also recognize that's not recognized as a card, therefore there's an error, and it just prevents the number of input errors. So that we went through this in detail in our core content videos if you want to know more detail, but other than that, we basically need to know for this question that general IT controls are something that impact the controls, policies, procedures across the entire IT environment, whereas an application control is specific to a particular software. For example, the payroll example I mentioned before. So in this case, we've got use of system logs to monitor attempts to access the operating system. That's going to be specific to one operating system. System software logs to monitor attempts to access the operating system. So this is impacting the operating system specifically. It's not across all IT. So it's not a general computer control. That would be an application control. And then B, the procedures for documenting, reviewing, testing, and approving systems or programs in changes. So that would be a procedural change. It's not a specific application. Sorry, it's not a general IT control. And then C, the organizational structure and operation of the IT activity, including controls over access to equipment and data files. Sorry, what I should be saying is not a general computer control. So we know that A is operating system. So what I should have said is that operating system is a general system across, it's not specific to a payroll system or accounting system. And you've also got software logs to monitor attempts. So that's something that's general across multiple, your whole IT environment. So what I should have said is that is a general computer control. This one here is a procedure for documenting, reviewing, testing, improving systems or programs and changes. So that's not specific to a particular program, that's across the whole IT environment. So that was also a general computer control. And then C, the organizational structure and operation of the IT activity includes controls of access to equipment, data and files. Again, this is a control which impacts the entire IT environment. So that would be a general computer control. So therefore D by deduction is probably the correct answer. So procedures to assure only authorized personnel receive the output from a weekly update of the trade debtors master file. So this is an accounting application because it relates to the accounting app, and it's specific to that file only. It doesn't apply to the payroll, doesn't apply to the general operating systems, and it only allows authorized personnel to receive the output, right? So that's specific to the accounting software, therefore it's an application control, not a general computer control. These three are general computer controls, therefore D is the correct answer. All right, which of the following statements best describes the term assurance services? Okay, so now we're starting to get into questions where it's starting to cycle similar style of questions. So this is quite similar to the first one we did, where it describes the assurance services as basically being improving the the credibility of information, etc. So I think we've done enough questions up to this point where the questions will start to cycle, and you can deduce the answer fairly quickly because it's just a variation. So again, this is just another ethical question which we can figure out. So this is to do with discount on wines, that's self-interest, done. This is another question to do with Governor General. So I think we'll probably leave it there. This will be the last question we'll do. And then after that, you've now got the skill set to now approach these questions by yourself, finish off the rest of the questions to get up to question 53. And then now we'll move on to the next video, go through module 2, repeat the process there, give you the skill set, give you the approach, give you the notes and technique and deduction skills to get the correct answer. for as many questions within the time limit, and then we'll hand over to you to then practice over and over in your own time. And if you can do this perfectly, if you can get all of these correct, all 53 correct, you should be in very good stead for your final exam. Do that for all 5 modules. You should ace your final exam. So let's finish off this question, and then we'll finish off this video and move on to Module 2. So for a financial audit of a government department carried out by an Auditor General, which of the following would not be an output of the audit? Okay, so this is very similar to the first question. We mentioned that if it's a financial audit, you're going to get all the similar things that you get with an existing audit of another company. So you get to get an audit opinion, you're going to get a report of key issues, you're going to get a letter of controls. The only thing you won't get is performance review, which is the second part of the Auditor General's function, but it's not a financial audit. So clearly this one is not the right answer. Okay, so let's leave it there, and I will move on to the next video, Module 2. Hopefully you found this useful, and please continue to practice those questions in the meantime, and I'll see you in the next video.